Money, in its broadest sense, is a medium for the exchange of goods and services. Its story begins with the ancient practice of barter, where people directly traded items they needed. As societies grew and trade expanded, this system became inefficient, leading to the emergence of commodity money items with intrinsic value such as gold, silver, or even shells. Over time, the need for safer and more efficient ways to store and transfer value gave rise to early forms of banking. In ancient civilizations, merchants and temples provided grain loans to farmers and traders, gradually evolving into more formal banking institutions that facilitated deposits, loans, and the issuance of promissory notes. The concept of a central bank traces back to the 17th century. In 1668, Sweden established the Riksbank, which was chartered to lend to the government and act as a clearinghouse for commerce. Not long after, the Bank of England was founded in 1694, becoming the archetype for modern central banks. Its purpose was to purchase government debt and stabilize the currency. Other European central banks soon followed, often established in response to monetary instability or the need to finance governments during times of war or crisis. Early central banks were frequently private entities with public responsibilities. They issued notes that circulated as currency and held deposits for other banks, gradually becoming the banker's bank. Their large reserves and extensive networks made them natural lenders of last resort during financial crises. Money creation is the process by which the money supply of a country increases. In modern economies, both central banks and commercial banks create money, but they do so through different mechanisms. Central banks create money primarily in two forms: physical currency, such as notes and coins, and reserve deposits, which are electronic money held by commercial banks at the central bank. Central banks increase reserves by lending to commercial banks, purchasing assets like government bonds, or directly crediting accounts in exchange for assets or loans. Historically, central banks also created money to finance government spending, especially during wars or economic crises. Most of the money used by the public exists as deposits in commercial banks. When banks issue new loans, they simultaneously create new deposits, expanding the money supply. This process is often misunderstood. Banks do not simply lend out existing deposits. Rather, lending itself creates new money in the form of deposit balances. For much of the 20th century, the money multiplier theory dominated explanations of money creation. According to this theory, central banks could control the total money supply by setting reserve requirements, the fraction of deposits banks must hold as reserves. The idea was that a given amount of central bank money, or reserves, could be multiplied by commercial bank lending up to a limit set by the reserve ratio. However, in recent decades, most developed countries have abandoned strict reserve requirements, finding that the actual constraint on bank lending is not reserves, but the availability of creditworthy borrowers and regulatory capital requirements. Central banks now primarily influence money creation by setting short-term interest rates, which affect the cost and demand for loans. From the 19th century until World War I, most countries adhered to the gold standard, defining their currencies in terms of fixed weights of gold. Central banks held gold reserves to back their note issuance, and money creation was tightly constrained by the need to maintain gold convertibility. When gold reserves fell, central banks would raise interest rates to attract foreign gold inflows. The gold standard served as a nominal anchor for the price level, but it also limited the ability of central banks to respond to domestic economic conditions. After World War I, central banks began to focus more on domestic economic stability, employment, output, and price levels alongside external stability, such as exchange rates and gold reserves. The interwar period saw experimentation with monetary policy, often with mixed results. For example, the U.S. Federal Reserve's adherence to the real bills doctrine and its missteps during the Great Depression contributed to massive deflation and economic collapse. The abandonment of the gold standard in the 20th century freed central banks to pursue broader objectives, including full employment and price stability. Central banks gained new tools, such as open market operations buying and selling government securities and, more recently, unconventional policies like quantitative easing. Historically, governments often finance deficits through direct money creation, especially in times of war or crisis. During the U.S. Civil War, both the Union and Confederacy issued unbacked paper money to fund military expenses. In the United Kingdom, until the year 2000, the government regularly financed part of its deficit via an overdraft at the central bank, known as the Ways and Means Advance. Throughout history, central banks have often acted as engines of state finance, lending directly to governments or purchasing government securities. The monetization of sovereign debt has been a recurring theme, though modern central banking generally seeks to limit this practice to avoid inflation. Today, central banks primarily influence money creation and the broader economy through several key tools. They set policy interest rates, such as the federal funds rate in the United States, and conduct open market operations by buying or selling government securities. They provide emergency liquidity to banks through lender of last resort facilities and set macroprudential regulations, such as capital and liquidity requirements for banks. By adjusting interest rates, central banks affect the cost of borrowing and the willingness of banks and borrowers to create new loans, and thus new money. While central banks can create base money reserves and cash, most money in the economy is created by commercial banks through lending. The degree of control central banks have over the money supply is a subject of debate. While they can set the price of reserves through interest rates, they do not directly control how much money commercial banks create. The effectiveness of monetary policy depends on broader economic conditions, including borrower demand and bank risk appetite. Monetarist theories, which advocated for strict control of money supply growth, were influential in the 1970s and 1980s, but have since been largely abandoned in favor of interest rate targeting. In response to the 2007 to 2008 financial crisis, central banks adopted unconventional tools like quantitative easing, which involved large-scale purchases of government and private assets to inject liquidity into the financial system. These policies blurred the lines between monetary and fiscal policy, reigniting debates about the appropriate role of central banks in money creation and government finance. The history of money creation in central banking is a story of evolution from the early days of commodity money and private note issuance to the sophisticated, policy-driven central banks of today. While the mechanics of money creation have changed, the fundamental challenge remains: balancing the needs of the economy for liquidity and stability with the risks of inflation and financial excess.